tech is such a large bubble. Tech valuations are subject to a very, very large correction, in my opinion, just to kind of get in touch with reality. Leave a crisis out of it, in my opinion. Okay, again, that's strictly my opinion. However,
hello and welcome to the Alternative Edge Report. I am your host, Olivia Vaz, and today I'm joined by special guest, John Butler, investment consultant and author. John, thanks for joining us from across the pond.
Oh, my pleasure, Olivia.
John, you've said that fiat systems always end up back to gold. What tells you that we're at that breaking point now, if we are?
Well, if you take a look at what's going on around the world in recent years, there have been some very, very definable historical trends, which are quite good parallels to some past episodes in history of fiat currency systems finding their way back to gold. For example, if you're going to run a fiat system, you really need to be a hegemonic power over those who are entering into commerce within your region of the world, or in the case today with the United States, the entire world. Take ancient China, for example, which introduced paper currency and which was able to inflate that currency as desired. Well, that led to an endless series of booms and busts in Chinese history, and I won't go into more detail there. Then you had the French experiment with paper currency during and after the French Revolution. That also found its way back to gold. The problem is this, is that if you begin to rely on fiat currency, and if you begin to rely on inflating that fiat currency to fund excessive spending, deficits, debts, and so on, well, then you're going to eventually have a problem with your trading partners because they're going to not want to exchange real economic goods and resources in exchange for what becomes a chronically inflating currency. Now, step forward to today, we see that the United States has been reliant on inflationary monetary policy for decades. At times, the inflation's been relatively mild. At times, it's been very, very dramatic. And in recent years, it's been very, very dramatic. And so this is accelerating the timeline. The United States at the end of the Second World War was roughly half the size of the global economy in total. Today, it's only about 20%, and that share continues to decline gradually. I stress gradually. But that's a long, long way from where things were. And the United States, of course, as we know, has been running chronic government deficits and running double-digit increases in broad money growth for years now. And that has led, of course, to chronic inflation. And so this scramble for gold you see around the world is but one step on the road back to what I believe will be proper, full international gold remonetization to settle international trade in the coming years.
How do you see that we're seeing gold being pulled back into the global monetary system right now?
Well, it's not yet officially back in the monetary system, but unofficially, it's come a long, long way as gold reserves are accumulated at an accelerating rate by a large number of countries. And that number of countries does not only include countries with which the United States has a challenging relationship. In some cases, there are countries that are quite strong allies of the United States who are also accumulating gold. They see it, of course, as a hedge. But the thing is, beyond a certain point, the value of gold reserves available to official institutions grows above and beyond the value of treasuries held by those official institutions. And when you actually have more gold available to settle international trade imbalances, which are historically very, very large today, well, then what do you end up using? What's the ultimate form of settlement when the treasury share of global reserves is getting ever smaller and the gold share of global reserves is getting ever larger? You eventually reach a tipping point where gold begins to be officially remonetized to settle the international balance of trade.
Will this be the finale to, I guess, finally expose the real difference between physical gold and paper gold?
Well, that's certainly a possible sort of side effect of this, you might say. Now, there are a lot of concerns that the way in which some supposedly gold collateralized ETFs and other investment products, there is some concern that the way their prospectuses are written, and the way in which securities and banking law can be interpreted, including so-called force majeure clauses, those contracts and those clauses might allow these funds to play a bit fast and loose with the amount of collateral they'd actually have. Now, they claim that they use that flexibility in their documentation just for day-to-day liquidity management purposes. But if you get into a crisis and there is a run on these so-called paper forms of gold because people don't trust them anymore, they might not be able to keep up with the outflows, and you might find that when the game of musical chairs stops, you don't have a seat. And so I do recommend to my high net worth and institutional investor clients that they think very, very carefully about the way in which they invest in physical gold. Now, when it comes to investing in gold mining companies, or when it comes to investing in gold royalties and streaming companies, that's a different matter. You sort of have to enter into securities and banking law to invest through listed securities and that sort of thing. But when it comes to simply ensuring that you have a meaningful portion of your net worth in physical gold, do it properly. There's no need to do it through an ETF. There's no need to do it through securities and banking law and force majeure contracts. There is a way to do it through direct ownership. And in fact, there are quite a few ways to do it through direct ownership. And so, yes, for that portion of your gold exposure, that is the pure physical form, I suggest going straight to the source, as it were.
You've called private credit the snake in the grass. What's the most dangerous risk hiding there today?
Well, the biggest risk is the risk of the banking system in general. 2008 exposed just how opaque the modern banking system has become. You can't even be sure where the leverage is anymore, because what does leverage mean? Leverage is some multiplicative factor of risk times the amount of leverage that is borrowed funds you have behind that risk. The banking system is hugely leveraged. However, how they're leveraged on the surface and what is seen by regulators is not really how they're leveraged beneath the surface, or in the grass, you might say, and remains unseen by regulators. They might be lending money to hedge funds who are doing things that the banks don't fully understand, taking risks they can't fully quantify. And the lines of credit the banks extend to those hedge funds might therefore be excessive and expose the banks to excessive risks in the event that credit hedge funds start to fail, private credit hedge funds. But that's just one example among many. There's another practice called so-called collateral transformation, where an entity comes to a bank and swaps out low quality collateral for higher quality collateral. And how high the quality of collateral is, to some extent, is a judgment call. It's in the eye of the beholder. And again, the regulators have rough guidelines for how they categorize different types of collateral, but ultimately, they don't really know. And so the biggest risk of all is that people just don't know what risks they're taking. The unknown unknowns, almost, as it were.
I mean, it sounds like private credit is the new subprime.
It certainly could be. It certainly could be. However, it's worse than that, because other factors equal, the collateral that went into subprime, it was still a house. It was still bricks and mortar. It might have been exposure to risky mortgages, but behind those risky mortgages, there were actual bricks and mortar. When it comes to private credit, the type of collateral that they take is all over the place. Sometimes they take a share of future revenues of a company. Sometimes they take a share of the residual value of the assets. But in some cases, those assets are intangible assets, such as software patents or something, that have no easy to determine value in future, and in fact might depreciate at a very, very rapid rate. And so the nature of the collateral is so opaque when it comes to private credit that, yes, you could be talking about something that bears some resemblance to subprime, but is actually even worse once the smoke clears and you realize, oh my God, what are we left with now following the bankruptcy of our counterparty?
John, final question. If the global order cracks tomorrow, what breaks first? Currency, credit, or tech?
Well, the thing is that tech, in my opinion, is such a large bubble that even if things don't crack per se, tech valuations are subject to a very, very large correction, in my opinion, just to kind of get in touch with reality. Leave a crisis out of it, in my opinion. Okay. Again, that's strictly my opinion. However, that could be the trigger for credit issues because a lot of the private credit market is involved in the AI bubble in various ways. So the two overlap in a Venn diagram of sorts where that overlapping area could actually be quite substantial. But then if you add in all the other areas where private credit is active, and again, for that matter, even traditional bank credit, which is lower risk, other factors equal, but that doesn't mean it's low risk outright. There's just a lot of areas where things could go wrong. And so if it cracks, it probably begins with the riskier assets out there, the less liquid assets out there, such as private credit, such as the tech bubble, or what I believe is a bubble. It could also be other forms of risky assets. I mean, the list is very long in this day and age. But then it moves towards the center. What I mentioned a moment ago, banks lend money for liquidity and leverage purposes to hedge funds of all stripes, special purpose vehicles of all stripes, all manner of entities that take risks that are, again, relatively opaque and relatively illiquid in nature. But the problem is that bank line of credit might have to be pulled in an emergency, and the bank might not pull it fast enough to avoid taking big hits. And so the problems begin at the periphery of risk and illiquidity, but they migrate towards the center of what is perceived to be lower risk and higher liquidity. But as you go through that process, the risks go up, the perceived risks go up, and the available liquidity goes down. And eventually you reach a point where the central bank will feel an emergency need to get involved, not unlike what happened in 2008 and 2009. And once the central bank is involved, then what has been taking place as primarily an equity market and credit crisis becomes a banking crisis. And the banking crisis, if the central bank becomes aggressive enough, creating fresh liquidity, becomes a currency crisis. And the currency crisis today would be a crisis of the dollar itself, other fiat currencies too, but a crisis of the dollar itself. And that means that all fiat currencies will devalue sharply versus gold and other real assets, not only gold, silver, other precious metals, and other real assets that people believe will withstand the chaos, as it were. So that's the way, in general terms, I believe it would play out. It's not at all dissimilar to 2008. But the scale of the leverage today is higher. It cuts across more asset classes than before. It's harder for regulators to see, understand. And ultimately, the United States is even more threatened with an undermining of the dollar's relative perceived safe haven status as a result of everything that I've mentioned. Again, the U.S. economy is in even worse fundamental health today than it was going into 2008.
John, it sounds like this interview would be a great rough draft to The Big Short #2 coming in. Wow. Phenomenal takes to keep us ahead. John, thank you so much for your time today. Great interview, great chat. We hope to have you on again.
Oh, my pleasure, Olivia. Thank you.
Thank you so much. And thank you everyone for watching the Alternative Edge Report to, again, keep you ahead. Make sure to like and subscribe so you don't miss out on future interviews.